Section 5 to 1 Understanding the Volatility Index, VIX, Key Considerations for Risk Management. 5.1 Portfolio Protection and Hedging. The VIX can be utilized as a tool for portfolio protection and hedging strategies, allowing investors to manage and mitigate potential downside risk. Here are some ways the VIX can be used in portfolio protection and hedging. VIX options. Investors can use VIX options to hedge their portfolios against market downturns and increased volatility. By purchasing VIX put options, investors can gain exposure to potential increases in the VIX, which typically occur during periods of market stress. If the market experiences a decline and volatility rises, the value of VIX put options may increase, offsetting losses in the portfolio. VIX options can provide a direct hedge against market volatility, particularly for broader market indices or portfolios. VIX futures. VIX futures contracts can be employed as a hedge against market volatility. Investors can take long positions in VIX futures to profit from potential increases in volatility. During periods of market stress, VIX futures tend to rise, potentially offsetting losses in the underlying portfolio. However, it's important to note that VIX futures have expiration dates, and their prices may not perfectly track the spot VIX index. Roll costs associated with maintaining a VIX futures position over time should also be considered. Volatility targeting strategies. Investors can implement volatility targeting strategies that dynamically adjust portfolio exposure based on changes in volatility levels. These strategies aim to maintain a constant level of portfolio risk by adjusting the allocation between risky assets, such as stocks, and less risky assets, such as bonds, according to the level of volatility. When volatility increases, the allocation to risky assets is reduced, providing a natural hedge against market downturns. Conversely, when volatility decreases, the allocation to risky assets is increased, potentially capturing upside potential. Volatility ETFs or ETNs, exchange-traded products, ETFs or ETNs, that track the VIX or VIX futures can be used as hedging instruments. These products allow investors to take long or short positions in volatility, providing a hedge against market downturns. By holding volatility ETFs or ETNs, investors can gain exposure to changes in the VIX, which can act as a hedge against portfolio losses during periods of increased volatility. However, it's important to note that these products may not perfectly track the spot VIX index or volatility levels due to factors such as contango or backwardation. Options hedging. Investors can utilize options on individual stocks or indices to hedge against specific downside risks. By purchasing put options, investors can protect their portfolios from declines in the underlying assets. Additionally, option strategies such as collars or protective puts can be implemented to limit downside risk while allowing for potential upside participation. It's important to recognize that while the VIX and related hedging strategies can provide portfolio protection, they also have limitations and associated costs. Hedging strategies involve trade-offs, and there is no one-size-fits-all approach. The effectiveness of VIX-based hedging strategies depends on factors such as timing, market conditions, and the specific characteristics of the portfolio. Investors should carefully assess their risk tolerance, objectives, and consult with financial professionals to determine the most suitable hedging strategy for their specific circumstances. Options-based hedging strategies and the use of VIX derivatives can provide effective means of managing risk and protecting portfolios. Let's explore these strategies. Protective put. A protective put strategy involves purchasing put options on individual stocks or a portfolio of stocks. By buying put options, investors have the right to sell their stocks at a predetermined price, the strike price, within a specified period, until the option's expiration. This strategy provides downside protection as the put options increase in value when the stock prices decline. The cost of the put options acts as an insurance premium against potential losses. Collar strategy. A collar strategy combines the purchase of a protective put option with the sale of a covered call option. This strategy involves buying put options for downside protection and selling call options to generate income. The put option helps protect against potential losses, while the call option generates income, partially offsetting the cost of the protective put. The collar strategy limits the potential upside gain but provides a defined level of protection. VIX options. VIX options can be used as a direct hedging tool against market volatility. By purchasing VIX put options, investors can hedge against potential increases in market volatility. VIX call options can also be utilized to hedge against declines in volatility. These options provide an opportunity to gain exposure to changes in implied volatility and can act as an insurance policy against market turbulence. VIX futures. VIX futures contracts can be used as a hedging tool to protect against market volatility. Investors can take long positions in VIX futures to offset potential losses in their portfolios during periods of increased volatility. VIX futures can be utilized to hedge against market downturns and act as a form of portfolio insurance. However, it's important to consider the cost of maintaining VIX futures positions over time, as roll costs can impact returns. VIX exchange-traded products, ETPs. Exchange-traded products that track the VIX, such as ETFs or ETNs, can provide exposure to volatility and can be used for hedging purposes. These products allow investors to take long or short positions in the VIX, providing a direct hedge against market volatility. However, it's crucial to understand that these products may not perfectly track the spot VIX index and can be subject to factors such as contango or backwardation. When employing options-based hedging strategies and VIX derivatives, it's important to consider factors such as the cost of the options, time decay, implied volatility, and the specific characteristics of the underlying assets being hedged. Additionally, risk management and monitoring of the hedging positions are essential to ensure the effectiveness of the hedging strategy. Consulting with a financial professional or options specialist can provide guidance and expertise when implementing these strategies.